Bismillahirrahmanirrahim. In this video, we are going to talk about intra-company transfer of depreciable assets. We have already talked about the intercompany transfer of inventory and land in the previous videos, and if you have gone through them, you may have observed that the intercompany transfer of land was easier as there was no depreciation. However, intercompany sale of depreciable assets is a bit different from intercompany sale of inventory and non-depreciable asset. In this video, we are going to present the accounting treatment for the elimination of intercompany transactions related to depreciable fixed assets. So in this video, we are going to talk about elimination of unrealized gains or losses or intercompany sale of depreciable assets like machine, equipment, building, etc. Next, we will solve exercises on elimination of unrealized gains or losses on intercompany sales of depreciable assets. We will solve exercises on controlling interest in income on intercompany sale of depreciable assets, both upstream and downstream. We will also solve a problem on work paper entries intercompany sale of equipment. Please like, subscribe and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in a comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video help students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. We hope that this video helps CPA, AICPA, ACCA, CMA, and other accounting program aspirants. We also hope that this video helps fresh graduates who have joined the companies and want to refresh their learning on elimination of unrealized profit on intercompany sales of depreciable fixed assets. So let us start with accounting treatment for the eliminations of intercompany transactions related to depreciable fixed assets. In case of depreciable asset like equipment, truck, building and any long-lived asset, depreciation is charged, and depreciation is charged on tangible assets. In case of intangibles, they are amortized. Both tangible and intangible assets are treated the same way, and we have to defer any intra-company gain, and we are going to re-establish the historical cost. So intercompany sale will be recorded both in the financial statements of the parent company and the subsidiary. However, the consolidated financial statement will report it at historical cost. So the affiliated group and any gain or loss on such transaction will also be eliminated. In case of depreciable assets, the appropriate gain on intercompany transaction is recognized. That is, it is recognized in piecemeal. That means gradually through depreciation. The firms using the cost of partial equity method An additional objective is to equate beginning consolidated retained earnings with the amount of consolidated retained earnings reported at the end of the prior reporting. Regarding firms using the complete equity method, this final objective is not necessary because the parent's retained earnings already reflects all adjustments accurately. The entries also serve to equate beginning non-controlling interest and prior ending non-controlling interest for upstream sales. Let us talk more about it with the help of an example. On January 1, Adam Company sells an equipment to Ryan Company, and I am intentionally not specifying which one of these is a parent or a subsidiary company. The selling price is 90,000, historical cost is 100,000, accumulated depreciation is 40,000, and the remaining estimated life of the asset is 10 years. So selling price is 90,000. So Adam is selling it for 90,000, and Adam purchased this equipment for 100,000, and this is the historical cost. The equipment has accumulated depreciation of 40,000. So the book value is 100 minus 40, that is 60,000. Then Adam sold this asset that has a book value of 60 for 90,000. It means Adam will record a gain of 30,000, and let us look into the journal entries, and we are start with the seller's company, that is Adam's company. So Adam is going to receive cash 90,000, and equipment will be credited by 100,000. Accumulated depreciation is to be debited by 40,000, and the gain on sale of equipment will be credited by 30,000. The journal entry in the books of buyer will be equipment is going to be debit for 90 and cash is going to be credited by 90. Now, from the consolidated financial statement perspective, we have to remove the gain on intercompany sale of 30,000, and we have to re-establish this equipment at the historical cost of 100,000. Now, since the asset has a remaining life of 10 years, so from Adam's perspective, the book value is 60,000, and 60,000 divided by 10 will give us 6,000. So Adam would have recorded 6,000 of the depreciation per year had he not sold it to Ryan. In the books of Ryan, depreciation will be recorded for 9,000, that is 90,000 divided by the number of years, that is 10, and as the cost of equipment for Ryan is 90,000, but from the consolidation perspective, 3,000 of the depreciation expense should be eliminated because the actual depreciation expense for the affiliated group is 6,000, while we are recording depreciation for 9,000. So this 3,000 must be eliminated. So the consolidated entry in the year of transfer will be, we have to eliminate the intercompany gain of 30,000. And then the equipment should be re-established at its cost. So if you make the T account for the equipment, we have credit for 100,000. We have a debit of we have a the historical cost is 100,000. We have a credit of 100,000 and a debit of 90,000. So to re-establish it for its historical cost, we must debit the equipment by the difference, that is 10,000. So equipment is going to be re-established for by debiting by 10,000, and we are also going to re-establish accumulated depreciation because accumulated depreciation is debited by 40,000. So the consolidated entry will be gain on sale of equipment is debit, equipment is debit by 10,000, and accumulated depreciation is credit by 40,000. So let us see what we have done so far. Cash is debit for 90,000 and this cash is set off by cash credit of 90,000. So cash is gone. Adam credited the gain for 30,000 and gain is debited by 13,000 to eliminate it. Ryan debited equipment by 90,000 and Adam credited equipment by 100,000. So to re-establish equipment at its original cost, we should debit equipment by 10,000 and we need to re-establish accumulated depreciation. So we are crediting the accumulated depreciation by 40,000. Now there is an overstatement of depreciation by 3,000 in Ryan's book. So depreciation expense should be credited by 3,000 and accumulated depreciation debited by 3,000. The accumulated depreciation has a credit balance of 40,000 and to re-establish we have debited accumulated depreciation by 3,000. Now when we are reducing the depreciation expense by 3,000, it means the net income will increase by 3,000 and when net income increases, it means that the retained earning will also increase by 3,000. This means that the gain is recognized as reducing depreciation expense will increase net income and retained earning. And this entry will be repeated for the next 10 years. There is a gain of 30,000 and this gain of 30,000 divided by the number of years, that is 10, will recognize 3,000 of it each year, and this is what it means by recognizing the gain in piecemeal for depreciable assets. Let's take a look at year 2 and the same steps will be repeated and the asset is to be re-established for 100,000 by debiting equipment for 10,000 but debiting retained earning for the seller for 27,000 and not 30,000. So equipment is debit by 10, retained earning is debit by 27 and accumulated depreciation is credit by 37. I can see that here the accumulated depreciation is balance is 37. So in year 1 gain was debited for 30,000, and since gain was will be sitting in the retained earning, so in year 2 there is no gain but retained earning, and from a consolidated perspective we will increase the retained earning by 3,000. In other words, we increased it because of increase in net income, and net income increased because of decrease in depreciation expense. So in year 2 we have debited the retained earning for 27,000 because we recognized on a consolidated basis 3,000 of the gain. We recognize 3,000 of the gain because the buyer used that equipment to generate revenue, and now the asset is being consumed. So whatever the asset being consumed or sold to an outsider, it's the same effect once it is consumed. It is consumed for purpose of servicing the outsider, therefore we recognize 3,000 of profit. So in year 2, retained earning is debited for 27,000, and we have credited accumulated depreciation for 37,000. In year 3, again we are going to debit equipment for 10,000, and now we are going to debit retained earning for 24,000 and not 27, as again 3,000 of gain is recognized in the buyer's book. You can remember that there is an overstatement of depreciation expense for 3,000. Remember, we will repeat this entry for 10 times or for 10 years. Debit accumulated depreciation and credit depreciation expense until we use up all the gain or we resell the asset to the outside party. Also note that it doesn't matter whether it is an upstream or a downstream sale. If this was a upstream sale, and if this was a downstream sale, that is from the parent to the subsidiary, then rather using the retained earning that we have used each year, we would have used the account called investment in subsidiary. So equipment will be debit for 10 and investment in subsidiary is debit by 27, and accumulated depreciation is credited by 37 in the year number 2 as it was over here. The only change is rather we use retained earning seller, we will be using investment in subsidiary. So that's the difference that you need to know whether it is an upstream or a downstream sales. So next let us solve an exercise on upstream sale of equipment. Now on January 1, 2011, Sherwood Company, an 80% owned subsidiary of Paradise, sold Paradise Company equipment with a book value of 600,000 for 840. So they recorded a profit of 240,000, and this is a intercompany profit. The equipment has an estimated remaining useful life of 8 years on the date of the intercompany sale. Paradise Company reported income from its independent operations of 550, and Sherwood Company reported a net income of 300,000 in the year 2011 and 2012. Calculate the controlling interest, that is the parent company, in combined net income for the year ended December 31, 2011 and December 31, 2012. Now the income, so let us first of all look for the year 2011, and the income for the parent company in transactions with the third parties is 550. To this, we are going to add the share of the parent company in Sherwood company income. So, first of all, we are going to calculate the Sherwood company income. So, S company reported a net income of 300,000 from its independent operations, and from this we are going to subtract the intercompany profit of 240,000 because this is intercompany, it has to be eliminated, and P company would be recording excess depreciation on the intercompany purchase, and the excess depreciation will be 240,000 of total depreciation, and the life of this asset is 8 years. So this has to be added over here because this depreciation is decreasing the profit. So we are going to add this up. So the total amount will be 60 plus 30 is 90, and from this 90,000 of net income of S company, parent company has 80%. So 80% of 90,000 is 72,000. So the total P company's combined net income for the year 2011 will be to 622,000. Now for the year 2012, income of the parent company do not change, it remains the same 550,000, plus the parent company share of income in the subsidiary realized in transactions with the third party. So first of all, as company's reported income from its independent operation is 300,000, and there is no intercompany profit of 240 in the year 2012, but we have to add back the excess depreciation that is recorded by the by the parent company. So the total amount is going to be 330,000, and from this 330,000, 80% belongs to the parent company, and 80% of 330 is 264. So the P combined net income for the year 2012 will be 550 plus 264, that is 814,000. Okay. Let us do one more exercise. And on January 1, 2011, Polar Company, which owns 80% interest in Superior Company, sold Superior Company equipment with a book value of 400 for 560,000. So there is a intercompany gain of 260,000. Sorry, 160,000. The equipment had an estimated remaining useful life of 8 years on the date of the intercompany sale. P company reported net income from its independent operation, including sales to affiliate, for 400,000, and Superior Company reported net income of 200 from its independent operations in 2011 and 2012. Calculate the controlling interest, that is P parent company's interest, in consolidated net income for the years ended December 31, 2011 and 2012. So once again, the income of P company realized from third parties is going to be, you see we have the 400,000 minus the intercompany profit of 160,000 plus, you see the total excess depreciation will be to be charged will be 160,000, and this is for 8 years, so that makes 20,000. So the income of P company realized in transactions with the third party is 4 minus 160 plus 20, that is 260,000. Then Polar company's share of income of superior realized in transaction with the third parties. Now Polar company has 80% interest, so 80% of 200,000, that is 160. So the total is 420,000. This is for the year 2011. Then for the year 2012, again the income of P company realized in transaction with the third parties is 400,000, that is the income over here, 400,000 plus the excess depreciation charge, so that makes 420, as in the second year there is no intercompany profit to be subtracted. To this we are going to add the Polar company's share of superior company realized in transactions with the third parties. Once again it is 80% of 200,000, so that is 160,000, and the total will be 580,000. So this completes the problems on elimination of unrealized profit on intercompany sales of depreciable fixed assets. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or send me an email, and inshallah I will reply you back. I am always here to help you. Thank you so much and happy learning.